Thank you very much. Bernd Slage, Chief Executive Officer of Kommunalkredit. I'm very pleased speaking to you today on the release of our results as for this morning. To refresh, the business model of Kommunalkredit is in a certain way a one of a kind. We are a very fast growing provider of infrastructure financing solutions with a, I would say, unique full service product spectrum. We are set up across the key sectors in infrastructure energy financing across a variety of products that you see on page 2, across the different geographies of Europe, extended by selective export credit enhanced financings in Africa, across the segments of infrastructure energy and public finance. And we are refinanced by a combination of customer deposits, senior unsecured financing, and covered bonds, which represent an even mix of our funding basis. Given that the engine of our growth and the engine of our result production is the infrastructure energy market, I'd like to give you a quick snapshot of the status quo of the market as per 2023. Over the past decade, the market has grown with a compound annual growth rate of 12%. The market as such within Europe had slightly decreased by around about 20% in Europe, but the decrease in Europe, given the way we play our business within the niche that we are looking at, had no effect on our performance or balance sheet. We still see in Europe dynamism in the market, fostered by the EU Green Deal, by ambitious national climate targets, and consequently by the reconfiguration of the European Union's energy mix. At the same time, there's a lot of push on the market to respond to the shifting demographics in the market, still in response to the lessons learned from the COVID pandemic situation and by a variety of geopolitical tensions. So to a certain degree, although the market slightly has decreased in 2023, we, in the context of the markets, I believe, have performed tremendously well. The highlights of our performance are summarized on page 4. We have grown our net income interest ratio by 53% to a result of 192 million. Our operating result has grown by 58% to 134 million. And thus, we have managed to operationalize extraordinary or valuation results as of last year into an operating ongoing result. We have delivered our results by a high level of efficiency. The cost-income ratio came out at 36.7%, and we have delivered a 25% return on equity after tax. The asset quality of the institution remains high, with an average portfolio rating at A-, and this is all in the context of a very strong Tier 1 ratio at 20%, or respectively 17% for the core Tier 1 ratio. The new business, you recall on 2 pages previously, I had shown that the market has contracted by 22%. The new business we have written is 1.8 billion. This is 11% less than in the previous year. And the rationale for writing less business is not because there was less opportunities. It is focus and discipline in terms of EBITDA, profit generation, and focus where we want to head the bank to. While the new business has gone down by 11%, the portfolio has grown by 14%. The growth of the portfolio is a response to less refinancing or early redemptions, and consequently we have a very strong back book, which is going to deliver and foster also, and I come to this a little bit later, very strong results for the year 2024. In the business that we have looked at in growing our results, we focused on 3 transactions which represent our 2025 sustainability targets. One, we want to deliver more than 40% of our new infrastructure energy business to support the green transition. 2, we want to contribute up to 10% for our annual new infrastructure energy business as a means to grow green solutions driven by innovation and similar. 3, we want to contribute with our annual activities in the infrastructure energy business towards social infrastructure and all the digitalization and communication, which altogether help to improve people's life. Our first target, where we wanted to contribute more than 40% to green transition, was outperformed with 54%. Our second target, up to a ceiling of 10%, was delivered with 3%. And to improve people's life, unfortunately, we have not succeeded to deliver more than 30%. We have contributed 24% of our business towards that KPI. In terms of profitability and in terms of growth, we have grown our total income by 41% to 230 million. Our expenses have grown more moderately to 93 million. The cost-income ratio consequently has come down to 36.7%. And this has delivered a result before tax of 136 million, which is a growth of 37%. And we have already we have grown and outperformed an already excellent result of 2022, lifting the return on equity post-tax to 25% on a 1% stronger Q1 ratio when compared to the previous years. The key drivers, I mentioned this, has been business growth as such, high cost discipline, although we have invested considerably, with 20 more million expenses, continuously low risk cost, and a very efficient use of our capital, which all resulted into fortressing our capital position. We have focused, I said this before, we have focused on margin. We are able to size opportunities the way we are set up. We are focused on the organic capital build, and we are focused to grow our capital and hence to strengthen our capital requirements, our capital basis, in order to maintain the momentum for future growth. We will be paying no dividends given the yield we are producing and given the yield we are anticipating, because of which we have strengthened our capital from 494 million to 594. Compared to the regulatory requirements, we are exceeding in all 3 categories with a CET of 17.9%, the requirement of 9.5%. We are exceeding by far with the Tier 1 capital of 20%, the regulatory requirement of 11.6%, and equally with a total capital of 21.4%, we by far exceeding the Pillar 1 and Pillar 2 requirements in aggregate of 14.4%. The funding strategy has been very balanced between the pillars of capital market financing and deposit financing. The customer deposits have grown from 2.1 billion to 3.1 billion, but more importantly, we have extended and lengthened and strengthened the maturity profile quite considerably over the past year. This all has led to a very strong net stable funding ratio of 135% and also strong liquidity cover ratio of 542%. In growing the business, we are on the right trajectory. The trajectory is supported by macro trends, the macro trends of energy transition, of the reconfiguration of the European energy supplies, and by digitalization. And last but not least, by focus on ESG parameters. We have grown our advisory business. You may have noticed in the press that we successfully advised the buyer of the 5th largest German electricity company, STEAG. We successfully advised the French investor on the acquisition of a major stake in a critical Polish infrastructure investment, and equally on the sale or on the purchase of renewable plants, whether on the wind sector or the solar sector in Eastern Europe. The risk profile remains low. We have given you on page 10 a glance over our total portfolio in terms of region, in terms of borrower, and in terms of rating. Overall, the portfolio is a rating of A-. 66% of the individual portfolio positions are rated investment grade. 38% of the positions are rated either AAA or AA. So we have kept discipline and have kept stable with an impeccable track record of very low risk costs since the privatization of the bank in 2015. This has been reflected in our ratings. We have an A+ stable outlook for our covered bond rating. For our senior secured issuer ratings, we run BBB- by S&P and by Fitch, both with a positive outlook, equally by DBRS Morningstar with a BBB flat and a positive trend. And also we have improved our ESG ratings by Sustainalytics and other providers, where we are awarded or tested prime status, the transparency level being very high and representing low risk in terms of ESG parameters. If you look into our track record back from 2019, we always have delivered a very strong return on equity, whether it was in zero interest environment or a growing interest environment, where you see the testimony in 2023, we got a strong capital position. Consequently, we have also grown regularly our risk-bearing capacity by growing our Tier 1 capital position. Our key rating drivers continue to improve, whether it's the capital position, whether it's profitability, whether it's the management of credit risk, or whether it is the business position in the market as such, where our business model has been proving over the past years to be highly resilient and at the same time very profitable. Our strategic growth trajectory will be focusing on capturing a larger market share of infrastructure energy market in Europe to implement future-oriented investments, notably in the digitalization, into reporting, into processes, but also in human resources on our coverage side, on our sales side, on our advisory activities. And with this, we are convinced that we will be unlocking complementary revenue streams in a way that we have already done in our first year of M&A advisory activity, which had a very strong contribution, and we will be keeping the momentum for our results in 2024 and then forward to 2025 and 2026. The key KPIs on which we are focusing on this is outperforming the cost of capital by delivery of a very strong return on equity and keeping a second to none cost-income ratio together with a very high discipline on risk taking. The guidance for 2024 is that we believe our balance sheet will again grow by 10%. We believe we will be writing new business volume in excess of 2 billion. The market has started very strongly in January and February, and this will be demonstrated by the year-end results for this year. We believe that the net interest income will stay or go above 200 million, regardless of decreasing interest rates as we anticipate. This will deliver at least a return on equity after tax of bigger than 15%, the cost-income ratio well inside 45%. We will be implementing by the time of close of the Alpha transaction a capital increase of 100 million, and we will be maintaining always a CET1 ratio in excess of 15%, and believe that the average portfolio rating will be at least BBB+, if not, as was delivered for 2023, at an A-. Our medium-term ambition is to outperform our cost of capital, and this is a return on equity in excess of 14%, to maintain the discipline on the cost side, as we have delivered that we, as one of the few institutions in Europe, manage and contain low cost level and actually continuously improve. our retained earnings will stay high, strong capitalization will stay high, and our asset portfolio quality will equally stay high. On the new business, we will be focusing to deliver our sustainability criteria, which, as I mentioned, doing annual business that contributes with more than 40% to the green transition and with more than 30% to improve people's life. And I believe you have seen that we can deliver both sides of the very same coin, profitability on the one side of the coin and the other side of the coin, contribution to social economic parameters of our society. The balance sheet will grow in line with our strong capitalization, and we are sincerely and deeply focused to continuously improve our rating, and we are confident that the results that we have posted this morning will pay into the currency of hopefully an improved rating that you will be seeing soon. Thank you very much for your attention and for your interest in Kommunalkredit. We shall be pleased if you will be joining us on our journey to success, to continued success and growth, and will be part of the story which is instrumental to the green transition in the European Union. We shall be pleased to take any questions. I'm looking to the conference organizer whether there's any question on his side. If there is none, I shall be pleased to wait another minute, or otherwise I suggest we conclude the conference, and I will be looking to a bilateral conversation if so desired.
Ladies and gentlemen, as a reminder, if you would like to ask a question by chat, please press the Q&A button on the left and type in your question into the chat field.
There's one question whether I can go into the details of the non-performing loan and on what loans there are. Absolutely. There is 3 non-performing loans which you find in the end of the report. 2 of the non-performing loans have an export credit agency enhanced background. One is for an ESG-driven project in Ghana, where commitment fees were not being paid or overdue for more than 90 days. Ghana is currently in the rescheduling. The net position of this loan is covered by the expected credit losses that have been completely reserved, and the loan is enhanced vastly by a Hermes guarantee, which in the end of the day is the Federal Republic of Germany. The same qualifies for a small exposure in the 6-digit amount for Nord Stream 1, which used to be an historic position of the bank. You know that since last year, on the sabotage issues, Nord Stream 2 exploded. It is not delivering any gas anymore. It is largely covered by the combination of the German export credit agency Hermes and UKIF. And again, the net exposure is less than the somewhere in the small 6-digit number. And the last one is the German offshore wind project, which had a combination of 3 effects. One effect had been the low performance of the wind turbines that had been supplied by a major European supplier. Second element, low wind speed. And third, that the rectification maintenance was done in the high season of wind speed, which was in the winter season. In all three cases, we do not believe that we will be losing money, but we have been building the NPL of 1.5, which as a net NPL after effectively deduction from the potential payments of the state will be coming down to 1%. I hope that answer is satisfying the question on the NPL side. The new owner, there's a second question, whether I can describe the new owner and the dividend policy. The new owner is the Swedish asset manager that has invested primarily in the green transition. The owner is or has been invested in the biggest Nordic wind developer, OX2, in the past, which they have sold. They are invested in Svea Solar, which is the biggest Swedish solar renewable developer. They are founding investor in H2 Green Steel, and they're also the founder of the investment company, which is Altor, is also a founding investor in Northvolt. In this context, to a certain degree, our focus on ESG rounds up their view of their portfolio because of which they intend to invest. They have signed the share purchase agreement a year ago. We have been given the sign-off by the cartel officers, and they, being Altor, are currently in the review of the ownership control procedure, which is, which I want to highlight, not the bank. They fully committed in the transaction. They're keen to come into the shareholding, and at the date of investing or clearance from the European Central Bank, they will be investing 100 million fresh capital into the company. They have a very modest to zero dividend retained earn policy. They want to grow and strengthen the capital basis to support me and the executive board of the bank to grow the bank's capital basis to 1 billion. There's another question on the airport exposure. Our airport exposure is very low. We have an exposure in, to the best of my memory, in Belgrade Airport and another exposure in Sofia Airport. Both had been mildly affected by the COVID pandemic back in 2020 and 21. Both at the time were on the construction site, and there was strong support by the relevant governments because of which all airport transactions in our portfolio are performing well, and none of them is on a monitoring list. Coal exposure, I don't believe from the top of my memory. We are supporting one company in the green transition, which may have coal-fired power plants as an asset, where we contribute to the geothermal business of the company. And we have advised Asterion on the acquisition of Steag, which used to be a black power producer, and is transitioning via their Icony business into a green company. Those loans have been repaid in 2023. Otherwise, we are free of coal exposure as far as I'm aware. If there is no other question, I thank you for your participation and for the contribution to the call. And in case there were any questions thereafter, I shall be pleased to take them up separately. Sorry, there's one more question on the deposit stickiness. Our deposits are very sticky. We have less than 10% overnight deposits. We have extended over the past year the average maturity of the deposits by almost a year. We have chunky deposits for 10 years, for 5 years, 3 years, and 2 years in the portfolio. The retail deposits stem around about half from Germany, half from Austria. The liquidity, you have seen this by the liquidity cover ratio, and you have seen this by the net stable funding ratio. As of the beginning of this week, has exceeded 1 billion. If there is no further question, thank you for your attendance, for your participation in the Q&As. I trust you find the results and the business model Kommunalkredit is pursuing attractive and interesting. And should there be any follow-up questions, please don't hesitate to go via our investor relation channels into dialogue with us, and we happily go into a deep dive for the response for your questions. Thank you very much for your attention, and have a nice weekend.